Got an email from Dave in Victoria, wants to know about Tesla. Your thoughts on the fluctuations in this one and the outlook over 1 year.
Right. So we are at Barometer investors in themes, secular themes where there's some change taking place for the better, where a company or a sector can be revalued versus its peers. And this is a great example, right? Tesla is a truly unique company, and I think some people look at it as a car company. Some people look at it as a battery or alternative energy company. But the reality is this is a company that is changing the world. So in full disclosure, I'm an investor, and I also drive one of the cars.
Oh.
I've driven one for 3 years, and I wouldn't drive a gas-powered car today.
Why? What's the advantage of it?
Well, I mean, it cost me about $5 to charge it for 400 kilometers. That's pretty good. Nothing ever breaks. Most of the time, if you ever needed service, you would call and they would connect to your car online while you're driving and put a software patch through, and you're done.
You found it reliable?
It's a very reliable car. But I like it for a number of reasons. I like it because the cost of battery cells a year ago was $500 for a cell. Today it's $190 for a cell. As the Gigafactory comes online, it'll be $150 per cell with a clear line of sight to $100 per cell. If they can get to $100 per cell, there is no petrol-powered drivetrain that can compete with an electric drivetrain. So from a cost standpoint, low cost. In the utility business, providing their battery walls that as an alternative to, say, building a peaker plant for off-peak for peak power, they think that they can cut the cost of capital spending for the utilities industry by a half. And if you build a peaker plant, it's like strapping 2 jet engines to the ground. It's not very popular in the neighborhood. Very hard to get permitted. If you can replace that with batteries, there's no permitting, there's no protesting, and a lot less cost. So they have a big opportunity, not to mention the automated driving, autonomous driving. And they have 150,000 cars on the road today collecting data on every mile they drive. So there's 4 million miles of road in the US. They cover that every 3 to 4 days. There's no other car company collecting that kind of data. So they have a real edge in a number of these areas, and so far they're executing. And if they can produce 500,000 of the Model 3, they could earn $20 a share. And at that point, then it's really not so expensive. Now that's a big if, right? So there's risk in this, but lots of transformative companies have risk.
But the market cap now about $50 billion, in line with GM, and about $6 billion more than Ford. You say they have hundreds of thousands of cars on the road, but Ford and GM would have millions of cars.
Really, Ford and GM run pension funds. They exist to pay their past employees. And it's a car company, right? This is not specifically a car company. So I think they're in the car business, and I think it's important. But they'll double the cell production of batteries in the world this year. That's going to 35 gigawatts. They're going to 150. So this company will dominate the battery business in the world. And it's a very, very big business, lots of uses, without talking about solar and other things. So there's a lot of optionality in this company.
Okay. Henry is calling from Hamilton. Go ahead, Henry, please.
Good afternoon, gentlemen.
Hi there.
May I please have 500 words, compare and contrast Carnival Cruise Lines and Royal Cruise? Which would you prefer and why?
Must be a teacher. Go ahead, David.
Well, maybe I'll take a different angle than you would like. The first thing I would say is, as a thematic investor, one of the key themes in the market that we're interested in right now is travel and leisure. For the consumer whose confidence has been going through the roof, one of the first things they spend money on is travel. And both Royal Caribbean and Carnival play right into that theme, as of course does Disney, right? So they're both really well-run companies. They're both really global companies. Frankly, I have to say I would buy either. I don't own either of them. I should, and we should at Barometer. We have shareholdings in Disney. We've looked at Marriott as well. But this whole theme is one that is going to continue to benefit, I think. And there's lots of new capacity coming and the ability to grow earnings. Both should grow their earnings sort of mid-teens going forward. And I think you could do well in either or.
Okay, Henry, thanks for that question. We'll squeeze in Edgar in Bobcaygeon, Ontario. Beautiful town. Go ahead, Edgar.
Yes, gentlemen, thank you very much for taking my call. I'm interested in AQN Algonquin, and I have put it in my TSFA, and I was just wondering if that's a good idea. Thank you very much. Bye now.
Thanks a million.
So we are investors in Algonquin. It's probably our biggest utility position, a utility-like position. It has outperformed the sector for quite some time. It, of course, has lots of different power generation, and it's been able to grow its cash flow and its dividend very handily at 4.7% yield. It's very attractive, and with some growth in that, it helps offset rising interest rates, which we believe we are facing going forward. So I'd buy the stock here. I'd continue to buy it. We own it. I know it's trading within a whisper of its all-time high, but this is a company that just continues to execute.
We're going to be back with David Burrows, President and Chief Investment Strategist at Barometer Capital Management. The topic, North American large caps. The number, 1-855-326-6266.